Hi, welcome to Financial Freedom Hub channel. It's been a while since we interacted together. It's been a while since I posted a video. I believe the whole of this year we haven't heard from each other. So I wish to welcome you to the channel and wish you a happy belated New Year. We trust that this year we are going to experience financial growth. We are going to encounter favor. We are going to go through blessings, and then we are going to make wise decisions when it comes to our finances. And then we are going to see financial explosion and growth that will lead to financial freedom. So I wish to welcome you to the channel. Those of you who are already subscribers, I welcome you to this new series that I'm beginning this time, Financial Literacy. So I'm going to teach you about finances. I'm going to teach you about the numbers game, how to understand finances when it comes to investment, what to know before you invest, and once you are investing, what to know, things you have to consider before investing, and then little things about our everyday finances. Interestingly, we go to school, to university, and we are not taught finances. We are not taught about money, which is one of the crucial things we use all the time throughout our school life. And so I'm beginning a new series. So if you are not a subscriber to this channel, I will admonish you to just go subscribe to the channel, and then you will be updated as we post videos, and then we educate ourselves and grow together. So once again, you are welcome to the channel, the Financial Freedom Hub. Like I said, I'm beginning a new series I dub Financial Literacy. You need to be literate financially in order to sail through these stormy times we are in. And so this first video, we are looking at what Treasury Bills are. I believe you have heard of Treasury Bills. Some of us invest in Treasury Bills. Some of us have heard of it. We don't know what it is, so we don't know how to even invest. So subscribe, and then I'll be showing you in subsequent videos how to invest in Treasury Bills and what to know about Treasury Bills, compare them with other investments, similar investments. So let's get inside and know what Treasury Bills are. So question is, what are Treasury Bills? Now, simply put, Treasury Bills, or T-bills for short, are short-term financial instruments. So they are short-term financial instruments that are issued by the central bank. So irrespective of which country you are coming from, in the US, it will be the Treasury, US Treasury. But you are in any other country, the central bank is the only institution of the government that issues Treasury bills. So they are short-term financial instruments that are issued by the central bank with maturity periods ranging from a few days up to 52 weeks. So the length or the duration of the Treasury bill maximum is 1 year. Now, we have different duration periods, which we will look at in maybe subsequent videos, but the longest duration for the Treasury bill is 364 days. That's 52 weeks or 1 year. So that's why we call it a short-term financial instrument. So it can mature within 91 days. That's the 91 days T-bill. It can mature within 182 days. That's 6 months T-bill. And then 364 days, that's 1 year duration. Okay, so they are considered among the safest investments since they are backed by the full faith and credit of the government. I told you in passing that it is the central bank, that is the government's bank of the nation, that issues Treasury bills. So it is one of the safest investments you can make because it is backed by the full faith and credit of the government. So nobody can run away with your money. No bank, no investment institution, or no online scheme or scam can take your money away. It is government that is taking this money. So when an investor buys a Treasury bill, what they are actually doing is they are lending money to the government. So when government needs money to undertake its activities and it doesn't have the money, the government can issue Treasury bills and then borrow money from the public through institutions or through banks or direct from the central bank. So a Treasury bill is simply lending money to the government. So any amount of Treasury bill you buy, you are lending money to the government. The government uses the money to fund its debt and pay ongoing expenses such as salaries and then military equipment. So the government expenditure, and the government doesn't have money for it, and so the government borrows money from the public. So that is what T-bills are. And now T-bills are sold in denominations. Now in the US Treasury, it ranges from $1,000, that's the standard, that's the minimum, up to a maximum of 5 million US dollars. So it is sold in denomination. So let's say in Ghana here, it is sold in 100,000 lots, and then it increases like that. So sometimes it can become difficult for an individual to purchase one lot depending on the denomination of the bill. So in a subsequent video, I'll be showing you that if you want to purchase and you don't even have that amount, you can purchase a smaller lot through banks, commercial banks that can buy the bigger denominations, and then they can resell. So they are denominated in ranges like $1,000, and then it moves on like that. Okay, so let's look at how Treasury bills work. So let's look at an example of Treasury bills. So Treasury bills are sold at a discount to the par value. So you see, when you are buying, somebody says, I bought Treasury bills, and then after 91 days, I am going to earn this amount on it. Normally what happens is the government or the central bank discounts the T-bill at what it will be paid for or sold at the expiry or at the maturity of the bill. So you will pay less, and then when it matures, you will receive the full amount. So that is how Treasury bill works. So the Treasury bills are sold at discount to the par value. So the par value is the value at maturity, which is its actual value. Okay, so for example, a Treasury bill with a par value of 10,000 US dollars may be sold for 9,500. So you are buying the Treasury bill today at 9,500, and when it matures, depending on the maturation period, whether it's 91 days, 182 days, 364 days, when it matures, you will be paid this 10,000. But meanwhile, you are purchasing it at this discount. So you buy a Treasury bill at a discount, and when it matures, you get the actual value. So that is how Treasury bill works. So the government, through the central bank, promises to pay the investor the full face value of the T-bill at its specified maturity date. And upon maturity, the government will pay the investor $10,000, resulting in a profit of $500. You remember, you bought it at 9,500. That is a discounted value, and then it matures within the maturity period, and then you earn a difference of $500. So that becomes your interest or your profit. So that's how Treasury bill works. The amount of profit earned from the payment is considered the interest earned on the T-bill. So the amount of money you earn, between the difference between what will be paid you at the maturity and what you paid for it at the beginning, that becomes your profit, and that is considered your interest on the Treasury bill. And that depends on the percentage that the Treasury bill is going for. So look at it in a diagram form. So that is the par value. So that is what will be paid at maturity. So you can see it moves from here to here. But this is the purchase value. So you see that it is sold at a discount price. This is what you are going to pay for it today. So you can see that there is a gap between the paid value today and then the maturity value. And so this is the investor's return or profit that you are going to make. So this is the full value of it, the actual value, but it is sold at this discount today and you purchase at this discount price. And so the difference between this and this gives you your return on your investment. So as an investor, this is the interest or the profit you are going to make, depending on the percentage that is the Treasury bill is discounted to. The difference between the face value of the T-bill and the amount that an investor pays is called the discount rate, which is calculated as a percentage. So that's what I just explained. So you look at the diagram again and you see that this is what you are going to pay. So that is the discounted rate. And then this is what you are going to get. That is the actual value of the T-bill. So it is discounted at a percentage, let's say 5%. The example we look about above, where you purchase it at 9,500 and it matures or you get 10,000, that gives us a 5% discount rate. But I believe that today we have treasury bills that have a discount price of 12%, and then the percentage is determined by the length or the duration of maturity. So it means a 91-day will have a lower discount rate than a 182 or 364-day bill. All right, so that's what happens with the treasury bill. So in this case, like we have seen, the rate is 5% of the face value. So that is what treasury bill is all about. You buy it at a lower price, and then it matures, and then you take the full value, and then you can decide to roll it over, and that is you repurchase again, and then the profit that you earned will also begin to earn profit for you. So that is a solid investment, and like I told you, it is the safest form of investment. So thanks for watching. Remember to subscribe to the channel and like and share the video, and also leave a question or a comment. If you have any question you want us to explain or answer, leave it in the comment section, and then we'll get back to you. But in the meantime, we'll see you in the next video, and the next video is going to be on how to purchase treasury bills. So in the next video, I'll be showing you how to purchase treasury bills. So if you are not yet subscribed, subscribe and turn on the notification sign, so that when we post the next video, you will be alerted, and then you can watch and learn, and then we grow together financially. Thanks for watching. I'll see you in the next video.